farm
Yeah.
economics. And we'll wear, God, I wish I
All
had
right,
where's my
everybody.
trucker
Hello.
hat? Yeah.
And thank you for listening to our pre-webinar chatter. You are here for the January 2025 jobs report and inflation update. My name is Albert. I am the founder of Albert's List. We're a job search, side hustle, and AI education organization, along with helping you understand the state of the job market and how it affects your job search. With me is my co-host Colin, and always our host, Dr. Reilly White of the University of New Mexico, Associate Dean of the University of New Mexico Anderson School of Business, and a economics and finance professional and professor who comes to us every single month with insights, news, views, and perspectives that you can use in your job search wherever you may be, including the current news and everything that may be affecting around everything around what companies may want to do to invest in hiring and so forth. The way this webinar goes is Dr. White has a presentation prepared and he's going to go through it. And during the whole thing, you can ask questions, provide your own insights, and always have fun in the webinar chat where we always have a lot of conversation and enjoyable moments. So without further ado, Dr. White, I'm handing it over to you. Thank you so much for spending so much of your time with us every single month and providing us some important information for our present and our futures.
Ah, thank you so much for the incredible introduction, Albert. Thank you, Colin, for having me as well. Thank you, fantastic members of the Albert's List community, for dialing in on this Tuesday evening. You should be eating food, enjoying the fine weather, finding eggs from your closest Safeway whenever you can find something. Eating eggs, perhaps, if you're particularly well connected with certain groups. I am incredibly grateful to meet everybody. I'm so glad. Please trade off. Please linked in with each other. You're always welcome, of course, to reach out to me as well on LinkedIn. I encourage everyone to ask questions throughout these presentations as well. I've got slides. I've got some questions. No such thing as a silly question. So I've got this feedback. Ross, of course, saying break down the past jobs report to types of jobs created. I got that going. I'll show you where the jobs are being created. And also kind of alluding to that fact, we had a question earlier about why does the economy, quote unquote, seem good in aggregate, but why am I not feeling it? Why is consumer confidence down? Why are all these things happening? And we're going to break that down too. So I'm very grateful for everybody here, especially those who have been here before. Thank you for coming back. You're incredible. I'm delighted every time I see your names, if I recognize you. And then, of course, for those here for the first time, it's incredible to meet you. So let's rock and roll. Let's do this thing. Let's do this shebang. So I'm going to share this. I adjusted my screen resolution to reflect our, hopefully this will allow me to go into presentation mode in 1 second without too much errors. And then I'm going to do a little bit of adjustment. Today's AI generated image. Impossible. What's impossible about this? This is Albert's List top secret rocket program, obviously happening here, strangely, seemingly in Marin County. Good luck on that zoning. But very, very interesting to see what happens there. So this is, I know, this is very hard. How much does this staff cost you, Albert? This must be a fortune. Look at all these people. They're just standing around looking at screens. This isn't aerospace engineering jobs. You're responsible. The little tech bounce back we've seen due entirely to Albert and his shenanigans. So let's break down the jobs report that we had. It is February, but January data was our most recent data, so we call this the January jobs report. There was something interesting that happened, though, in January, which you may have read about. Each year, the Bureau of Labor Statistics undergoes kind of an adjustment in its population check. So when it determines things like all of this data comes from a series of surveys that they issue out to the general public. And the surveys are all kind of based on and work around the question of a viable sample size that's diverse enough that one can extend broadly to the country as a whole. But that depends on you having the right population parameters. And so based on, say, new data, and one of the factors of last year is that immigration was higher than we anticipated. That added more people than we thought. What that does in aggregate is they make these adjustments in this. And so overall, these numbers are hard to compare on a month-to-month basis than our normal month-to-month connections. So keep that in mind as you approach this. So this is great. So what do we got going on? What's happening? What do we have to care about? So 143,000 jobs in were added in the last month. That's a very low number compared to the last few months that we've seen. It's not a bad number, but it's also not good. It's also highly concentrated in just a couple sectors we keep talking about, mainly healthcare, again, breaking down about 66,000 jobs there. Healthcare, of course, we spend about 17% of our GDP on healthcare and related services. We've never quite found the answer for this, for healthcare expenditures in a reasonable way. And consequently, and secondarily, we also have to think about the aging population, the history of concerning healthcare issues and comorbidities that is affecting the American population and expanding spending in this sector at an incredibly high rate. So whether you're in Mississippi, you're in California, whether you're in Wisconsin, you're going to end up seeing a lot of growth in this sector just because people are spending tons of money here. It's also a lot of interest in venture capital, private capital, in building and building out and buying this stuff. And so we're seeing a lot of push, a lot of hiring still in these areas. And so most of this is healthcare as opposed to social assistance in general. Albert points out we should become nurses, healthcare administrators, doctors, and tangential roles. A tangential nurse. What does that mean? I'm just slightly at the angle of these things. That's what that means. I just barely touch the healthcare sector. We added about 32,000 government jobs as well, which is actually very interesting. Let's keep an eye on what this number means in the next few months. So obviously the big news in January 2025 is we changed administrations. We have about 3 million federal workers right now. As you know, if you are one of those federal workers, you received a rather concerning email from an HR account recently. And we've got a few of them that I work with on staff or in the community here in New Mexico. And I got some sense of them. I'm like, show me the email. Let me see what it looks like. It is the email. And they ask you for 5 points about what you did last week for efficiency purposes, etc. But at the same time, this will undoubtedly result in significant layoffs that are not incorporated into this data right now. And that's incredible. Melanie points out medical coders hold the real power. Absolutely. Do we cover this? No. Do we got this? No. What is this? No, it is true. Healthcare equals low paid, overworked nurses. Preach. Absolutely right. And Vanita says, healthcare jobs are all frontline clinicians and health tech. Absolutely true, too. And so when we think about this, it's not we're adding 66,000 doctors is what I'm saying. I'm not saying that's desirable or undesirable. There's other issues at play. For instance, we have a lot of barriers to becoming a physician within the United States. One of them, of course, being that you have to go through a bunch of not only all of the qualifications to meet the regulations. One of the things I'm working with at the state level is we're trying to figure out ways with a healthcare shortage in my state for doctors, and we're trying to figure out ways that international physicians can qualify. But medical boards are very complicated that way, if those of you who are familiar. And so we have kind of an artificially low cap on the amount of doctors available. And as a consequence, that's one of the reasons doctors are both highly compensated and also why medical programs themselves can be allowed to be so egregiously expensive when it comes down to these things. And you end up being a doctor with also a correspondingly incredibly high amount of loans. But there's a lot of other issues at stake. So that's one issue is supply and demand in certain jobs like this. And so who picks up most of the slack when you don't have few doctors like this? As Vanita points out, it is these frontline clinicians, health tech workers, et cetera, and all. And Vanita also points out, and this is a good point too, there's a lot of inefficiency, and AI, I think, will help. I agree with this. My hope for AI, most fundamentally, is that it can straighten out some of these healthcare issues. It's already proven very effective at some forms of diagnosis. It's performed very effective in other ways. I think this could be very, very influential. And you point out as well, economic incentives are not aligned with payers and providers. That's right. Incredible long time to become a doctor right now. Incredibly long time. Those are looking for different career pathways. You know, you can always get a PhD in economics or finance. It's kind of fun. No, don't do that to yourselves. Do the best you can. Be an amazing person with hopes and dreams and do other things too. But if you are interested in the medical profession as well, they have been going gangbusters. But again, it's based on those, often not always high-paying jobs. Other services, about 17K, financials activities, about 7K. And then we enter a whole slew of disappointment. Construction has slowed down considerably. It is winter. We are not adding tons of construction jobs across the country, but we're also seeing very disappointing aspects in other areas. So information basically flatlined again. Bam, we got to bring, speaking of a We need some cardiac help to bring the information sector back online because we're not seeing hiring there. Although some of the data from December that I'll show you showed that the Bay Area in particular, some of those losses leveled off in very interesting ways. We have transportation and warehousing flat, utilities flat. We lost leisure and hospitality. It is winter. We expect those jobs to dry up. Those are restaurants, those are hotels. Educational services, mining and logging, and professional and business services. Those professional and business services are your accountants, they're your financial planners. Financial activities would probably be that category. But looking at all the other areas, could be legal, could be HR, all the other stuff that supports businesses. And it's a very, very vast sector. Also disappointing as well. Yes. Albert says, I love opining on the Laffer curve in Pigovian taxes. We need lower interest rates. Financial activities equals hedge fund owners. Whoa, whoa. Let's rock and roll. A lot of things to address there in this magnificent adventure, Albert. So yes, the Laffer curve, as Albert drops in this webinar chat, was invented by Arthur Laffer. What a fun guy. Very funny man. Always laughing. We're not quite sure at what. In the 1980s, he came out with this kind of relationship that looks at the question of the amount of revenue a government brings in and the tax rate. And instead of it kind of going up kind of monotonically over a long period of time, we raise taxes to a high level. People just pay those taxes and we get more taxes. We actually found that there's a curve, they call the Laffer curve to it, where eventually you reach some level, some equilibrium, where if you raise taxes more, people stop paying it, they shirk it, they move out, things happen, your actual tax takings go down. And so the position in the debate of where one might fit on the Laffer curve has dictated a whole slew of different things in economics and finance. So it's kind of looking at that relationship between tax rate and that and how much you bring in. Now, Pigovian taxes, on the other hand, are an interesting thing. And it was very in vogue about 20 years ago among economists who wanted to be, you want to show things that are, that we're demonstrating that we care about stuff. So that's advocating for taxes on stuff that does bad things to the commons, do bad things to other people. So for instance, it could range from, you could look at cigarette taxes because of secondhand smoke, could be Pigovian. Gas taxes on gasoline because gas pollutes could be a Pigovian tax. But there's obviously some give and take there as well. And in the United States, because we are reliant on our cars, we do drive a lot, and we don't necessarily have that public transportation in place in much of the country to accommodate that. A lot of Pigovian taxes are unpopular, for instance. As much as I wouldn't mind paying higher gas taxes if it resulted in better infrastructure at the same time, there's this big debate as to how that looks. And for most people, especially in states in the West, where we might drive an average of 12, 15, 18,000 miles per year, $9 a gallon gas is just something we don't like on the table. It's very common in part of that structure in other countries to possess that, especially in Europe. Yes, Vanita, healthcare is bullish on data and AI. Hasn't come to life fully. Absolutely agree with that. I think we're just at the tip of the iceberg with that. Ross says low interest rates cause massive inequity. Zombie startups. True, too, in that sense that when interest rates are really low, a lot of projects that people would pass on when interest rates were higher don't look good start looking good and people start investing money. And a lot of that money goes into places that don't pay off. In general, though, low interest rates, what they really cause is a lot of upsurge in economic activity. That gives a lot of people things like jobs. But when interest rates are low, financing becomes cheap. Things work out because companies who are looking to expand can suddenly do so. And for instance, you can get stuff like zombie startups, but at the same time, your cost of capital drops when interest rates are low, and you start to hire more workers. It's give and take. And there's probably something in there that involves, I can't necessarily say that startup quality varies, whether interest rates, I don't know the answer to that question, if it's higher or lower. I think that's a great research question, actually. That might be worth looking into. And if I had more time, paper on it. Trevor Shapiro, there are also the information technology jobs, including those that are secure, like security. I know, that's fun, right? So we got to rock and roll. What job are we looking for now? What do people need when crime is coming up and we have all this issue? Well, I'm a security worker, always jobs for that. IT technology jobs are good. Cybersecurity is very interesting. I've heard different things from the market right now. I oversee a master's of cybersecurity and business analytics. In that level, we do see a lot of excitement around people getting jobs, especially for different lines of work. But on the other side of that, a lot of people are like, well, I really need these qualifications to succeed here. I need these issues. And there's a lot of back and forth with that. Information should come back. Is AI baked into that? Vanita, good question. So information sector has been flat, as you notice. Is this going to be permanent? Is this going to be a state of being? Now, the information sector is cyclical. That means the highs are higher and the lows are lower than we see in a lot of other industries. Not only is it highly variable, but it's cyclical in ways that the rest of the economy isn't. It's a little bit of the canary in the coal mine. So when stuff changes, when interest rates rise, for instance, and a lot of venture capital money starts getting more expensive and starts changing the way they allocate stuff, the information sector feels it more. And so a perfect storm would be improvement in some of these interest rates, improvement of technology. There's a lot of debate, especially on AI, and looking at that question, and we debate each other as to whether or not. I think the general consensus is that AI, like any new tech, there's a lot of noise in the markets right now, not from individual AI experts. And I don't want to step on anybody's toes in that category because you obviously know your technology and what it's capable of. But remember, the economy is a very, very big system. And so even if I invented technology that can replace something else, it takes decades because of the frictions that exist in companies for that to actually pass through and make it work. So for instance, as I usually bring up this example a lot because I think it's fun. You remember telephone operators, right? People who would physically connect you to someone else. We solved that technology from the technology's perspective back in the 1920s, but we still had operators all the way up until the 1980s in certain regional markets across the country. And so there's a lot of frictions about how a technology goes through that system. So AI right now is promise and potential, and we're going to see applications that will send companies zooming skyward, but a whole bunch of other stuff that isn't going to pan out the way we think it will. And I think it's a sensitive sector that'll be very interesting, that'll have kind of an interesting ride over the next few years. Colin said, everything is priced in. Earthquake tomorrow, priced in. Impending asteroid impact, priced in. Zombie apocalypse, also priced in. Colin we talk about something called the efficient market hypothesis. And Colin is saying that the efficient market hypothesis might work in its most absolute form, which is the market, before you can even think of something, has already corresponded to it. That's probably not fully the case right now, in my opinion, because people can still make money off of market inefficiencies. So even though, yes, there are 100,000 PhDs, MBAs, finance experts pricing things into the market all the time, things still take us by surprise. There's still ways that people can, statistically speaking anyway, succeed in beating the market or meeting the market and making certain decisions that show it's very splotchy. So the market is very even in some areas and not in others, and that's a long one. So IT department is good. I've heard a lot of the layoffs in December and January have been IT. Cybersecurity is definitely bullish. Agreed on both counts, Sakura, and that's true. And so it depends specifically on the nature of IT. The job forecasts I've looked at and looked through, I was looking at McKinsey, I was looking at some other things that we've got data access to and other things. IT is a thing because in particular, the information security elements that make people look at this as a potential source of growth. However, it's variable, industry specific, and I don't have a fine breakdown on that right now. Colin says IT depending on sector. Absolutely right. There it is. And Sakura says, remember, I work for shovel makers. That's right. Who needs a shovel? Exactly right. This is the California gold rush again. So let's see here. Da, 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 da. Be Levi Strauss, not the miner. Make the jeans, not the miner. That's how my great grandmother's brother, when he came to this country, he came to California in 1849 and went into the non-gold business. Did very well. Did not pass that on to my side of the family. Founded a company that became Pacific Gas and Electric. Bum, bum, bum. Which, of course, not my responsibility, not my problem. Didn't get that money. Yes, I know. He left his sister like a $15 pension. My great grandmother. Peter Donahue, inventor of gas lights in San Francisco. So labor force participation, which is the amount of people who could work, who are actually in jobs, are holding steady at about 62.6%. Now that's okay. And so participation rates increase usually when the economy is good and they go down in recessions. One thing since the year 2000 is we've been getting older as a population. So the labor force participation rate has been dropping with every recession. So we go up a little bit, then we go down, and we go, and then a recession knocks us down, and then labor force participation increases slightly over the good years, and then it goes down again, and it never really recovers itself. And that's a function of our demographic situation right now. We just have a lot of retirees. We have this whole baby boomer generation moving through and retiring right now. And that's going to be a really, really big factor. So, but it is interesting, especially in these economies, when looking at a month-to-month basis, are people leaving the market or entering the market? And there can be good and bad reasons for that, and it's staying steady. And unemployment, because of the population justification, dropped to about 4% from 4.2. But as people have noted before, so let's talk about the thesis. Is it a good economy? Is it a bad economy? Evidence number one. Let's look at the JOLTS report, which I like because it's shocking. No, because it's very interesting. These are, it shows us job layoffs. And I've got here the monthly layoffs since about 2022, early 2022, across each different sector. And this was pulled back a couple weeks back. Next JOLTS report is March 11th. And so when you look at these things, look at the layoffs that are in the economy right now, notice they are trending upward. And one of the things as well, even though information is a high value sector, about 30,000 layoffs in the last month, it is normal for the industry to cycle, right? So we might have 1.8 million layoffs and 1.9 million new hires, if that makes sense. So we have kind of a continuous industry. So the layoff numbers themselves don't necessarily indicate bad news, but the tendency that it's going upward on a continuous basis across a number of sectors is mildly concerning. And so certain things you expect to be cyclical. Like, for instance, we know that construction layoffs are a little bit higher in fall as different construction kind of winded down. And then we've got, or wound down, I should say. We've got kind of steady layoffs in trade, kind of steady in financial activities. Leisure and hospitality, that's the sector that hires a lot and fires a lot by nature. So they're always typically one of the top 3 or 4 of sectors that we see right now. Professional and business services. Look at that purple. Look at that kind of, I don't know, fuchsia, not purple, pinkish fuchsia, looking for something else, as opposed to leisure and hospitality, which is a tasteful aubergine. The pink slides in professional and business services have been expanding. And those are a lot of technical, college-educated jobs that have been increasing in layoffs since 2022. There is more cycling here, and this is the interesting thing to see. So Scott asks, with consumer confidence index declining in February, not asks, but says, in February 2025, discussions include whether the recession is looming. And the uncertainty around a recession results is primarily due to a number of government and economic factors, Scott. That's a great question. Before, a few months ago, it was basically a 0% chance of recession now. Now I'm not so sure, because layoffs, of course, affect everywhere and every time. So the government issuing layoffs, for instance, especially among a lot of different technical workers, we may not see those workers absorbed fully into the market, even with a 6 or 8 month layoff package that many of them might receive. And as a consequence, as people look for jobs in certain sectors, this will kind of increase potentially the churn. We're not seeing, like we did 2 years ago, a lot more openings than we have unemployed people. When we got out of the recession of COVID, we had about twice the number of open as unemployed people. That's since fallen to about parity, about 1-to-1. Albert says, now that the government's experiencing layoffs, what would be a safe industry to work in? Is it blue collar? Is it construction, HVAC, or carpentry? So here's the thing. People are like, what is the safe sector? So this is a really good question. And I want to reiterate this, that from wherever you're coming from, it is a very natural human condition to say, I'm looking for the safest possible place to lay my head. That's why I chose to be a tenured faculty member. I'm like, please look at me. I'm online talking about the economy. And please don't fire me. But wait, I'm tenured. So it's one of those things that we all make, one way or another, we all make a decision towards to find safety at times in some way. And we kind of balance that with risk and potential outcomes in return. And your risk aversion is going to be different than mine, going to be different than someone else's. And so it's a very natural human question to ask. This is the hard part, though. The economy is tethered together in an interesting way. And so government layoffs, or even a decline in government expenditures, that affects contractors, that affects construction work, that affects a lot of blue-collar jobs. And because our supply chains are inherently interconnected, just a loss of demand in one area spreads out through the entire system. Higher prices for things like steel because of tariffs spread out through the entire system because we're all connected. And that's how we end up paying more. That's why companies end up saying, well, maybe I'll lay people off. But I wouldn't actually say, even though there is great demand for HVAC in construction, like if the government says, nope, we're going to be really, a lot of big construction projects have been generated through different government initiatives. If that's turned off, construction workers get turned off. If HVAC and carpentry stuff that might just, you could look at, well, some of this is normal, just normal. We always have houses and these things. Those might do well because as long as real estate prices remain high, being people feel rich enough to reinvest and invest in their homes. If the real estate market turns on the other side, we might see the opposite effect. Colin says geriatric care and undertaker services will never go out of fashion. This took a dark turn. That's right. I like this. Ah, yes. Undertaker services. I know one of those. But I mean, the amount you spend at an undertaker will vary, right? Do I want the light autopsy, or do I want the deluxe autopsy, or do I want like my favorite relative's ashes in an urn that is fancy, or like a cardboard box, or like a little matchbox? And what do we do? I don't know. That's a really good question. Geriatric care is increasing. And regrettably, healthcare in general, even for the jobs that were Anita explained in other places before, not going to necessarily high-paying jobs, healthcare in general is seeing a lot of demand. Albert says the one phrase I think everyone needs to know moving forward is downstream effect. Ah, very good, Albert. And that's just to understand that elections and economic policies are all connected. We must be mindful of how policies affect us. Bang, boom goes the dynamite. Absolutely, Albert. Melanie says, I know boomers who are house rich but can't afford to move. Absolutely. Trapped in a luxury palace of their own design. Maybe they were lucky and bought that fancy house, not fancy house, a normal middle-class home in Castro Valley, like my grandmother did in the 1950s, and then ended up, just holding it for life until she passes away, and just recognizing that huge increase in value over that time period. Fascinating things. One of the cool parts about my job is, and for the record, I have not inherited any wealth whatsoever. I'm a self-made schmuck, but a buffoon. Albert says the only mistake I made was not buying a 3-2 in San Jose for 150,000 when I was 8. Why didn't you do that, Albert? Every 8-year-old's sitting on a pile of 150K in cash. I make that mistake always. All those things. Every year you think this will be the year that house prices turn, and it never does. That's hilarious. So we got layoffs increasing. Now, road BLS travels. What did the BLS do in the last couple of in last month that was different? So they made kind of a couple changes that affected the unemployment rate. And so the unemployment rate went down as a function of their population changes, not because the economy suddenly was starting to do better. And that's the bottom line. So we asked the population. Charles Schwab, Bloomberg, the National Federation of Independent Business, NFIB. Are you an independent? I'm from the National Federation of Dependent Business, which is kind of true if you think about the role of higher education in our society. But asking the population the question, what is the single most important problem? Is it inflation? Is it quality of labor? Is it taxes, or is it cost of labor? It's like pick your magic thing. I'll get you some magic dice. Roll it. Which one would you pick in 2025? And you'll notice that if we were talking about 2015, those ancient and glorious days of before COVID, when life was full of it, people were worried about taxes as the most important thing, then the quality of labor, and then the cost of labor. Now, flip forward to COVID. Inflation became the primary concern. It is still tied with quality of labor for the highest level of concerns among business owners. And then secondly, we have taxes, and then cost of labor at the very bottom. And so this is very fascinating. And as Albert points out very correctly, the concern that people had about taxes fell, notably in 2017, which of course was when we had some very, very influential tax acts passed. And then, of course, it comes down again. And so there is a concern about business and taxes we're in. But right now, notice that they're looking at quality of labor and cost of labor. One aspect of limiting immigration for the economy is you will see labor shortages in sectors most prone to immigration. These are places where we already have or that rely on immigration, I should say. This is like construction. This is a lot of things that make us move and build and create things. And so immigration as a whole is a driver. And one of the reasons that we experience such abnormally high growth relative to our European peers or our G7 peers globally post-COVID was the increase in immigration that was unexpected. So companies were able to hire labor and as a consequence meet these higher consumer demand in this time period. So this is true. Benita says salaries haven't caught up with inflation. That's so true story. Although right now, Benita, to your point, salaries are increasing at a higher rate than inflation. To your point, if we include the years 2020, 2021, and 2022, we're still slightly behind that curve. So we're not where we would have been if inflation had never been there in the first place. Albert says, I read that Florida wants to do away with property taxes. Wild times. Interesting things, especially. Can you tax a property? We're going to talk about that in a second because I'll show you a chart of the country in places that have seen their home insurance revoked. And Vanita says this was a huge complaint by employees during the pandemic. So real wages. So this is back to Vanita's question, actually, about this. So since about the late part of 2023, inflation has been below wage growth. Wage growth is about 4%, inflation is about 3%. Small beans. As long as that wage growth is above inflation, that builds societal wealth in a way that's helpful. But we had, of course, that 2-year period where that was not the case from 2021 to 2023, when inflation exceeded the nominal wage growth by a significant amount. And we had negative wage growth, real wage growth. So nominal wages are what you earn, that 3% raise, minus, say, 2% inflation gets you 1% real wage growth. So it's real wage growth is the figure, the wage growth net of inflation. And it is coming down, and we have some inflationary pressures that are on the economy right now. And we haven't really seen wage growth go gangbusters. We haven't seen it increase at massive levels to suggest that inflation's around the corner, yet inflation's going up. And we'll explain why. Also, one aspect about the economy, going back to that question, why do things feel bad? If we look at the top 10% of earners, they represent about half of the money that's being spent in the economy right now, according to Moody's Analytics. If I even go back in time, just to say 2007 or 2006, that ratio was more like 35%. And so we're seeing a greater concentration of the economic movement that is controlled by people who earn the most amount of money. The lowest 20% of earners, and actually everybody in between, are seeing their earnings potential squeezed. Basically, so what this means is if you're not in the top 10% of earners, you're in a position where higher prices have affected your spending habits. You might be cutting back. You might be cautious. If you're in the top 10%, great. More Rolexes, less problems, I guess. So it's one of those things. And so when you look at aggregate spending levels and retail spending, it really is a rich person's economy as opposed to one that represented the poor. And that's kind of where we are. Eggs for everybody, says Albert. Exactly. All of the expenditures, people are now spending 80% of their income on eggs, which is terrible. Living in an eggshell house, walking on eggshells. They were. It's just amazing. Half of all spending. So this is why the economy is like spending is great. But wait, it's really just people with a lot of means. The poor can eat cake. Pedophores. Colin.
I'm just like curious, was there ever a point where people with no money were spending?
Oh, interesting. Like if you were like no money,
Yeah,
like zero income, like college
yeah.
students.
Would people with no money be spending? I'm just like curious what that's going
Interesting.
on. And then the second of all is like, is this even a good especially the graph on the right? Is this good? Is that bad?
Well,
Is it good that
here's
top
something.
10% are accounting for half of spending?
Is it good or bad? It shows that this leads into that's a great question, Colin. So your first question is, I don't have a lot of this is the hard part because by nature, the amount that people who don't have a ton of money or even in the bottom 20% or bottom 10%, they're not moving the economic needle in huge ways, even in aggregate, even if we just in sheer numbers being a large size of the population, not moving the economic needle in some way. What is moving the economic needle are the purchase decisions of very wealthy people. And so when we say the economy is doing well, we're saying it's doing well for people who are well off, really, because they are spending, they're continuing to spend, they feel comfortable, they've got property, they've got resources, usually, not always, of course. And I will tell you, of course, this is, of course, the Bay Area audience, where you can, of course, have a high income and then realize and not be able to afford a place to live. And this is no judgment around that. That is a function of the local economic factors. Buy now, pay later has entered the chat. So really good question, Colin. And it does distort fundamentally. Is it good or bad? No, but it's how we should read the economic data that's coming out, right? So when we say spending is good, it is good if you have a lot of money. And this is kind of the tale of two economies. It's about people who are comfortable spending and those who are saying or are falling behind. Remember, right now, the average credit card debt in California is slightly above $9,000 per person, which is fascinating to discuss. So top 10% of earners, Vanita. This is also different from net worth. Absolutely correct. Actually, I'll get to that question in a second. Let me get to Albert. So do you really think that saying it's really as bad as people think it is, even if spending habits seem to say otherwise? So it depends. Spending habits could be one thing. Spending could be rent. Spend could be facilities, could be things that don't make you materially wealthy. So that's tough to say. I do believe that people's interpretation of their own, I trust people's interpretation of their own financial condition. Albert says perhaps this stands to suggest those surveys about whether the U.S. is headed in the right direction or not are a better gauge than the monthly labor support. Maybe so, and that's kind of the big picture is there's clearly more going on here. And Vanita says, how do you define what's the top 10% of earners? This is also different than total net worth. Absolutely right. And remember this as well. So Vanita, you can have very high income people who have very low net worth, and also vice versa. You can have people who have tons of net worth because of, inherited estates and very low income consequently. And those two people spend things differently. And I don't have that data in front of me, Vanita, right now, but I will say that 10% of earners is focused on the income side. So looking at, say, a median household income of, I don't know, 70,000 across the country, and you're looking at those, that variance in between there, I'd have to double check the current 10th percentile of income, but my guess is it's somewhere in the six figures, but I don't know what level. Let me see. Maybe somebody can find it first. I love Reilly. What's 10% income in the United States? About 200 grand a year or so, give or take some. So solid, spend money, more money, fewer problems. And you think about this, and remember, this is about the country as a whole. So particularly when you're talking in a Bay Area context, this isn't necessarily a lot of money, nor is it a judgment. And that spending includes things that you need to survive. Oh my God, Albert has breaking news. Broken, right here on Albert's list himself. Albert's Washington desk. The House narrowly passed a Republican budget resolution that called for $4.5 trillion in tax cuts and a $2 trillion reduction in federal spending over a decade. Wow, very interesting. Oh, we got Aaron in the house. This is exciting. Look at this. Aaron's gonna run. He's my economic wingman over the board here. Aaron says our issue is labor mobility and family formation is a major issue. Labor mobility is a big issue. We look across the country, we're seeing labor mobility. People are moving less than before, and as a consequence, they're not going to areas that need economic growth. I was shopping at Vaughn's and Slade was there. Vaughn's, well, oh man, just there's no end to Aaron's amazement and amazement in class. Vanita says, namely, pretty well-off people, according to recent analytics from Moody's Analytics and Wall Street Journal. Thanks, Vanita, as well. I love these comments. Households with the top 10% of incomes making about $250 or more a year now account for half. There it is. See? There we're talking about this. I like when articles agree with data I have. If you have a question, type it in the chat or Q&A. I love it. This is great. Good questions, everybody. Moving on down. Good enough for work. So when we talk about cuts and how we make them, so interestingly enough, you've seen probably the chart, or maybe you haven't. The amount of physical numbers of federal employees we've had over the last 100 years or so hasn't really been significantly in the post-war sense variable. We have about 2.7 million people in the federal government. Where do they work? Who are these people? What are they doing? And you might be thinking of, oh, your buddy that works at the DOE, or oh, your buddy that does this or something else. It's Postal Service and census workers, about 600,000. It's Veterans Affairs, 500,000. It's Homeland Security. It's the Army. It's the Navy. It's the Air Force. It might even be the Space Force. It's the Defense. It's Justice, Treasury, Agriculture, and government workers, almost 100,000. Health and Human Services, a lot of different places, right? So this is the nuance of government cuts. And nor am I arguing against the fact that we need to be more efficient as a government agency. Anyone that's worked with government projects knows that efficiency should happen. But the trouble is that it's very, very hard. It's entangled, it's bureaucratic, it is largesse, it is Byzantine. And so it's very hard to look at this and try to make this much, much smaller. But that is nonetheless something that I suspect will be on the horizon. And it won't be 2.7 million workers cut. That would cause a recession, incidentally. If 3 million people tomorrow were out of a job, that would be enough for a recession. 2.7 million people work in the federal government. If you take off 100,000, 200,000, 300,000, that will move the economic needle downward, though. And how much over how long depends. And this is interesting, too. A lot of other expenditures that happen at the federal level, they can stimulate the economy in meaningful ways. If we pull that back, that does have economic consequences as well. And so one of the concerns that we have from Bloomberg and this are these changes priced into the market effectively? Are people really looking at a rational growth rate in the economy? And so in 2023, I'm guilty of this, and everyone else in the free world was like, the economy is going to grow. Sorry about that. Just had a spastic. I bought one of those. I'm one of those people that's driving spending to high levels now. So I bought one of those really fancy mice, but it's miraculously sensitive. And there's new technologies here that just make me flip through that and give my computer various seizures. Melanie says, and I like this Aaron and Ross, good discussion back and forth there. Melanie says, what was the impact of Clinton's federal layoffs? That is a really interesting question, Melanie. So going back in time, and let's think about the question is caliber and the size of those layoffs relative to other things. And let me try to get this. I know there's about 400,000 workers that were cut in that age. A 90s effort, about 400,000 workers were cut. And that was not something, and that was interesting because the 90s were such a booming period for the overall economy. And this is where it gets tricky. Is 400,000 workers a lot? Not a lot. They earned less money than they do now. And as a consequence, that consumer spending was less. That magnitude would be less. And so the economic effects, I would have to think back on this. It didn't cause a recession, obviously. But let me see. And there were 25,000 buyouts early 90s, and that was good. And then we did some other things. So let's see. Let me see if I can find something else. I don't know fully, Melanie. That's a good question. But it did likely, it set us on an interesting pathway. It was 1996, interestingly enough, that I think that we had the last balanced budget where we, actually had a government that spent as much money as we were bringing in. And that is an important thing to tackle in the long run, because the greater the amount of debt that we take on, that's debt that we owe ourselves. And so kind of take this on a different pathway. When we spend more money than we have, that is what we call an annual deficit in the economy. Those deficits, when we add them up over time, become the national debt. And to issue debt, what the government does is issue bonds. And bonds are things that you, me, and everybody owns. We put it in our 401ks. We have them in our pensions. We have investments that we buy. And government bonds are also held internationally. China has about 5% of them. Japan has about 5% of US bonds. So this is debt that's available in the world market to buy. We let the US government borrow our money for a fixed period of time and pay us an interest rate for that money. Since interest rates have come up, the amount we're spending on this debt is increasing, and it does form a drag on our overall economic growth. And so it is of importance in the long run over the next couple of decades to get a handle around debt, or it will have even worse adverse economic consequences as well. And so principally speaking, looking at this, if done well and done in a way that is reasonable, government expenditures can result in economic benefits over the long run. But where and how becomes the tricky portion in this. And that's a really, really interesting question. That's a great question, Melanie. And I'll have to look into the federal layoffs. I'll have to look at some of the academic literature in that too. Albert says, we need to encourage family planning in some way for everyone, because we don't have enough Social Security on their side, unless we reform Social Security, that is, which isn't out of the question. And didn't Obama sequester the military too? There had to have been impacts from that too, right? Every time we push back this way, it's all timing, right? So if we lay off 400,000 workers here or 200,000 there, that in itself doesn't lead to an economic downturn. It's the nature of spending. It's the nature of projects. I think the bigger effect is not the physical number of workers that are laid off in these capacities. It's how government expenditures change, because they support a number of different initiatives, contractors, infrastructure projects, et cetera. And this will have to adjust in accordance with that, which has ripple effects across the entire US economy. Now, the GDP growth right now, if we compare this to expected versus realized, 2023, we went much better than we thought we did. We had a higher immigration that brought in more folks to help do the jobs that were available to be done. And then we vastly exceeded our minimal expectation of growth that year. And then in 2024, similarly, we were saying, oh, there's going to be 1% growth. Then we realized 2.5%. But now, fool me once, you know, can the US government achieve a 2%, can the US as a whole, I'm sorry, achieve 2% GDP growth this year? Our realized GDP growth has been going down over the last couple of years. That makes sense. That government largesse is going away. The 5 trillion of stimulus went away. And so there's concern based on this chart and et cetera, that because the expected growth rate is so much higher now than it has been in the last 2 years, that this year might disappoint. And what would actually cause that? And let's talk a little bit about uncertainty and the risk of uncertainty in general, right? And so Trump, as a president, is one who thrives on certain elements of uncertainty, right? And so let's kind of think about this rationally. What are the real things, and what is the risk, and what is actually going to go down? So we've introduced policies that contribute to economic uncertainty in this administration. So tariffs, of course, are one of them, right? We raise the cost that ultimately gets passed down to consumers through higher business costs and other sectors that buy materials and then down to consumers. So that's uncertainty. Immigration restrictions, that has different effects, right? That's the question of looking at economic growth from the sake of, are there enough workers that we can find? Can we meet workers with different areas of the economy where we have labor shortages? And deregulation, which on the other hand could potentially boost the economy in certain sectors. And because of this, people are weighing this and saying, will one effect kind of outweigh the other? For things like tariffs, we've got a lot of posturing that the government is doing. They're using trade as a very strong weapon in international relations and saying, if you don't do this, I will give you a 25% tariff on this, or I'll do a reciprocal tariff on this, and I'll do this instead. And all of this has kind of a long-term effect on international relations that moves the United States from a position of being kind of a post-war hegemony sort of leader into a space where we're now playing a much more zero-sum type game with our trading partners. But some of these don't actually result in tariffs over the long run. They're just there to achieve certain policy ends, which could ultimately potentially benefit the United States in some of those cases. Trade chaos is freezing investment. Absolutely true, Aaron. And this is a big issue too, is that the issue with tariffs in general, and we talk in economics and finance about free trade. Free trade is something that increases the presence of trade, and we know that those rewards go to different people. For instance, we know there's inequality can be generated from poorly constructed trade relationships, even with the best possible intentions. We can also look at other issues too. And so when you have something like a tariff, it's effectively a tax on goods. And so, for instance, and going back to a case study we brought up last time, in 2009, President Obama initiated a 35% tariff on Chinese tires. What this did was save about 1,400 US tire jobs. But what that did was lower the competition in the tire market because the Chinese tires increased in price by about 28% in response to that 35% increase. That meant US firms didn't have this downward price pressure, and they eased up a little bit on their price cutting. And so prices rose 3% because of diminished competition in this market. Likewise, when we increase steel tariffs, what that does is increase the cost of anything that uses steel, construction, automotive industries, all that stuff. And so that ends up being passed on to consumers, and it's a drag on the economy. And what this is kind of a give and take. And the calculus that some may argue, and where the real debate is yes, I truly believe that this is like mainstream economic stuff. This isn't like crazy pants. Everybody in the administration took this when they took Economics 101. And so it's a debate between what represents a reasonable risk to take in a given situation. And that fundamentally is what we're seeing a disagreement with. And so I might argue as somebody with an economics and finance background that tariffs do kind of a net bad on the overall economy, and there's a whole bunch of reasons why. Somebody in the administration might say, no, this is good because even though, yes, it can do things over the short run, we know that tariffs are worse when kept over the long run, and they can achieve certain critical policy goals if done in the short run and actually benefit Americans. And so there's a disagreement there between that I might share with somebody in the administration around which of those represents the greater risk. So analysts highlight such policy-induced uncertainty could undermine confidence in governance and increases the risk of a recession. Not makes it happen, it does increase the risk of it. Now, specific data, and this is interesting because I knew that would come up about Apple too. Oh gosh, I got to catch up on these comments too. This is good. So Ross says government spending is keeping GDP over 2%. Without the government, the GDP is likely around 1%. Absolutely true. We do. There's a lot of government push here, and that's the real cost at this, as well as that a retraction of government expenditure, even more so perhaps than government workers themselves. Aaron says tariffs are bad, but quotas are worse. We run the risk of degrading of the trade system. True too. Scott says Wisconsin farmers share uncertainty caused by Trump administration policies. Funding freeze. Bam, farmers. Look at that. Good link, Scott. Albert says, does the investment in AI via Project Starlight offset tariffs, though? That's an interesting question. Apple even announced a huge investment yesterday in hiring 20,000 workers to bring operations stateside. This is good. So Albert, my interpretation of that is very political theatrics. And each administration can do that. It's not limited to this administration. It's something we all do. Certainly, President Obama said, hey, I saved 1,400 tire jobs, but we lost almost 4,000 jobs in the retail sector because higher prices meant people bought fewer tires. And so that's the nebulous and terrible effects of tariffs. So when Apple says, oh, Apple's a very large company saying we're going to onshore 20,000 workers because that's where the incentives are, doesn't necessarily mean that suddenly this is a renaissance of the US economy. This is an intelligent administration that knows that signals and certain demands done to certain strategic industries can help bring, or at least onshore some of those workers. And whether this represents a long or short-term investment is still very much up in the air. But certainly companies are making this calculation. But the downside risk is, will this be a net good or a net bad over the long run? Even if Apple says, I would have built a plant in China, but I'm building one in the United States, and I'm building one in the United States, and those input costs will be greater. Maybe they'll automate those workers. Maybe those workers will be paid more than the workers in China, but maybe there's going to be fewer of them. And maybe as a consequence, the product price of Apple will go up, and then they'll pass that on to consumers. Everything is connected, and every decision we make has an economic trade-off attached to it, and we can't pretend there isn't one. And that's the bottom line. See, the economic impact of deportation, that's a big issue too. So specific data on mass deportation on current policies is really limited. We don't have this kind of a thing. But large-scale deportations lead to labor shortages that reliant on immigrant workers, agriculture, construction, and service industries, among them. So I had this one. This comes up this is a really interesting one. I know there's one of you guys, one of my beloved and magnificent audience members who I respect and appreciate to the bottom of my tiny finance heart, always likes to bring up Section 174. Maybe it's the same person. Maybe it's the lobbying group. Maybe it's somebody else. And I have to say, I'm always very, very amused at all of the Section 174 stuff. So let me help you date on this, because one question was, basically, how is this affecting the economy? Is it really affecting the economy? What's actually happening here? Are we seeing issues with this? So as you know, 2017, and then coming into effect in 2022 with certain amendments on Section 174 that required businesses to capitalize and amortize R&D expenses over 5 years rather than expensing them. And this is a little tax trick, right? So back in 2021, I could make $1 million in revenue. I could say I had $1 million in software engineering labor costs, of which $1 million were deductible. I end up with $0 of profit, which means zero corporate taxes. Hooray! Next, 2022 comes online. Section 174 comes online in 2022. That $1 million I paid for software engineering labor, only $100,000 of which was deductible. That means I had to report a $900,000 profit and about $189,000 of corporate tax due. And then with the additional changes in 2023, $300,000 might be deductible that year, 10% from this year, 20% from the last year. My profit's down to $700,000, but I still end up paying $147,000 in taxes. And so kind of the question looked at this, why isn't anyone talking about Section 174? Will it be fixed? Why isn't people talking about this? You're running your startup companies, and I really do appreciate this question, miscellaneous member of the Section 174 mafia around this particular issue, because you're right, this is a big issue. And so the question is fundamentally, what do you think this should look like? It is true that from a startup perspective, man, the changes to this really, really made it hard, because you want, especially startups, looking at those first profits that come out of it. And again, an average startup takes somewhere around 60 months to 72 months to generate typically its first profit above its original cost. And that's due to a large number of factors. And when you have that ability, it takes so long to get to this point, and then you look for different things, paying some of this investment and other aspects, making that tax deductible, and seeing that go away is a big deal. And these corporate taxes do represent, amounts you have to pay that are representative of people you could potentially hire. And so it's a really big impact. And so different states, so a response to this is states have approached this. Several states have reached out, changed their tax policies. Georgia's one of them, to kind of adjust and accommodate these issues and make it a little bit more friendly on the state side. Federally speaking, this is tricky. Anything involving I suspect that this is the desire that we're going to see two things happen in the next year or two that will fight it out. The desire for a simplified tax code is going to fight out with lobbying groups and special interest groups who will argue for certain deductions on certain areas that will help incentivize certain economic growth. And depending on how the economy does, simple tax code or complicated tax code, but lower levels will prevail. And in one of those situations, Section 174 gets reformed. In another, it may not, and it may not be the priority. And so this is a very interesting question to follow. Now, one thing on the docket right now is mortgage rates. So if you're like some of us more fortunate people with low mortgage rates because you bought at a mysteriously lucky time, you'll notice that, of course, with mortgage rates still around 7%, this has drastically reduced your earning power. So if you were looking for a house with a $3,500 payment at a 2.5% mortgage, you could buy over $700,000 of house. When the mortgage rates are 7%, you can only buy about $500,000 or less of a house. And looking at this, how much, and this is the most interesting part, how much has the change in mortgage rates affect the typical household the typical household need to buy a home in certain markets? So look at this chart on the right. How much a household needs to earn to afford the typical home in their local market. San Jose, you could get by with $263,000 to buy a house in 2020. Highly levered, I want to point out, but you could still make it work. Now it's $454,000 as your household income that you have to get it. San Francisco, same thing, $220 to $339. LA, $157 to $279. San Diego, $142 to $273. You got to go to even Sacramento, $102 to $172. And then finally, I know what happens beyond this. Move to Bakersfield. There's no choices. All across the country, we're seeing drastically increased real estate prices, which make it much, and especially the combination of high real estate prices and high mortgage rates, mean that things are very unaffordable. Historically, for new homeowners, this is one of the most unaffordable times we've seen. But if I was bringing this back, and one of the questions we had was, this surely has to be a bubble, and consequently, could it change? I would point you to our wonderful Anglosphere neighbors, because one of the things that's very fascinating from as pointed out by the Financial Times a couple years back, was that the Anglosphere in particular has been really bad at building and matching the quantity of homes because of zoning and other complicated issues to demand. And as a consequence, these rates have soared. So Canada is in a terrible position with rates. Australia, New Zealand, a lot of different countries, even the UK, are seeing that home prices have exceeded drastically a reasonable household income. So it is a global phenomenon to see prices at this level, and it's so dominant, it is quite devastating. Bringing it down to San Francisco as an example, and one of the things that I'm looking at just the city across the various neighborhoods in the city. Oh man, I'm sorry about this. My mouse is just freaking out. I apologize. We'll get through it though, and I'm going to speed up a little bit because I took a lot of time in the first part. A lot of good questions today, so we're going to rock and roll. Thank you those for making it happen. So overall, across San Francisco, it varies from neighborhood to neighborhood. That $3.3 million average home price in Lower Pacific Heights now going for only $2.2 million. What a deal! And just think about this right across the board. Again, even seeing price decreases in more affordable neighborhoods like Bayview Heights. Fascinating to see this work out through this. Albert says, as someone who grew up in San Jose, I don't really know what the frenzy is. Are we excited to hang out in downtown Campbell, walk around Santana Row, and ride the bumps of Highway 87? Yes! If we could get another 10% to buy homes and our 34% who 100% own their homes to increase to 44%, this would transform wealth. Oh, Aaron makes a very interesting case here. I see what he's saying. another 10% to buy homes, and our 34% who 100% own their homes to increase to 44%. This could transform wealth. Make errands richer. Gold bars at the Sunnyvale Costco. A gold bar a day keeps the financial advisor away. Home insurance non-renewal rates. Also, if you're looking at this as well, one thing magically about more disaster-prone areas of the country, you will find a lot of home insurers because of these high prices, because of the economics of this. And when you're an actuary, you're computing kind of a calculation of aggregate risk, payoffs, and all that other stuff. We're seeing insurance non-renewal rates increase drastically. Tornado Alley, Albert, across the board. So if you've got tornadoes in the center part of the country and in a state situation that doesn't provide, and for instance, New Mexico too, east of New Mexico. So I live in Santa Fe, New Mexico, but next to us, there's a couple of counties on the east side. Those have some of the highest rates of hail damage of anywhere in the U.S., actually, right up from southern Colorado down into northern New Mexico. It's hailing all the time. It is a hail of a time. Aaron says, most don't know that 55% own stocks. And if we could increase that to 80% through economy-wide 401k, we can also transform wealth and investments. So many things, Aaron. Big government, big policies, big rocking and rolling. Very interesting stuff. But take a look at this. And this is devastating. You know, hurricane, obviously, prone areas, tornado prone areas, fire and earthquake prone areas across the mountains and other places. The safest place to be is New England and the upper Midwest. Exactly. Look, your home is going to be well insured if you live in the Minneapolis area. So U.S. home price index as well, just to kind of look at this across the country, real home prices versus nominal rates when we control for inflation. Our home prices have increased to a level that we've never seen before, but it looks much more of a moderate jump than we've seen. And so one of the aspects is this something the economy can sustain? And while a lot of people are arguing and saying, hey, this is a bubble, and of course it is, we only have a couple of years in recorded history in the last 100 years where real estate prices have actually dropped. What needs to catch up is incomes, affordability, and other metrics. And right now, barring a drastic wholesale change in the way that we zone in this country and the way that we build, we don't have good answers to meet the demand for homes in this area. And so that's a fundamental issue. Home builder inventory, months of supply. So silver lining for people who are looking at potentially decreased home prices. The months of supply are now higher. We have about 9 months of home builder supply. That decreases the incentive to build more homes, which is the downside, but indicates we've got more supply on the market. Are people suffering? Yes. Average Californian has slightly more than $9,000 of credit card debt, the most expensive type of consumer debt most consumers own. And across the country, we've seen these rates increase as well. Although in aggregate, when you look at household debt in the country, we're still fairly healthy because the biggest chunk of household debt is typically a mortgage, and most people still have lower interest mortgages that own a home. Geez, again with the problems. Now moving down over here. The single family rent index year-on-year growth rate. Visalia, 10% up in December 2024. But looking at other places as well, Modesto, looking at the rent index, up 7% in growth. What a golden opportunity for you to live in Modesto. Now is the winter of your discontent, made glorious summer by your 2.5-hour commute. You can see what happens through that. A lot of podcasts during that time. But across the country, the only areas of the country we're seeing actually decreases in rents right now. Raleigh, Durham, San Antonio, Sarasota, Austin, Fort Myers, places that build a lot, and the places that put a lot of places online. And that enabled them to cut back a little bit. Now, looking at loan balances that are delinquent, credit card bank delinquencies are still rising, although they've leveled off a bit. Automotive delinquencies are still rising, but they've leveled off a bit. Mortgage delinquencies are rising. Student loan delinquencies, still very low, likely to come up again fairly shortly, especially with some of the pullback and some of the forgiveness that the previous administration did. Sakura says, credit card debt is really interesting, very interesting to me because I was raised to pay off my credit cards before the due date if I have the money to build credit from college. Sakura, you were raised incredibly well because that is what I would advise and what I would encourage anyone else to do. But a lot of situations, you just end up not in those roles. I picked a career in finance just because, I had parents with 400 level credit scores that didn't quite understand that aspect deeply, although there were merciful. I'm very happy for my existence. But at that level, it is still a big problem. Across the country, these are 20% plus interest rates that people are paying on, and it forms a drag very hard to get out of. Without a meaningful benefit at some time. Florida also chilling at the $9,000 credit card level. Huge numbers. So, equities for a second. We've seen a good equity market so far. Will it continue? What's going to happen? We've seen a push into AI. We've seen the Magnificent Seven continue to be magnificent. 2024, the S&P 500 was up 25%. Russell 3000, Russell 2000, the smaller companies up a modest 11%. And then, of course, you've got a whole bunch of other indexes, international markets, not very well. Enter to January in 2025, we've seen improvements in commodities, EFA, which is kind of international stocks, the Russell 3000, the S&P. It's expected that the focus on U.S. economic growth will be much more broad in the coming years or so. Because if we look at the relative expensiveness of the US market, right now, one of the ways we look at that is through something called price to earnings ratio. So when you look at a stock, the price of the stock divided by how much it actually earns per share. And you can imagine, for instance, if you're a startup company or you're an overvalued company, you have a really, really high price, but you're not actually making a lot of money. You have earnings per share that are kind of low. And that's why you have a really high PE. So the higher PE, the more overvalued something is. On the other side of that, a low PE company, maybe it's something in like a non-sexy industry. Maybe it's a steel mill and you make a lot of money, but your price is really, really low. And so your price to earnings ratio is low. Also in the market, when the price to earnings ratio is low, that might indicate it's undervalued. And so right now in the S&P 500, we're pretty high on price to earnings ratio, some of the highest that we've seen in the long term. So what does this mean? What do you think it means, Colin? What do we do with this? Colin, questions.
I mean, not financial advice, by the way, but when I
financial
invest
advice.
and when
No.
I look at the stock market, the first thing I do is look at the PE ratio, and if it's anywhere higher than 30, I need to ask myself, is this justified? Because like the idea is you measure it against the 30-year bond, right? Which is in theory risk-free and has a guaranteed return. So everything needs to be measured against that. This is a quick crash course in how to invest responsibly, by the way. But if any PE ratio above 30 needs to be heavily justified on a ratio of risk versus potential return, right?
Right.
And then the higher it is, the more you're gambling. And I would say any more than 60, and you're in a very red zone. And yes, Albert, Tesla has a ridiculous PE, and that is why, hey, I have personally never invested in Tesla because that's effectively Tesla saying, hey, either we will, there's only two ways to equalize that, right? For Tesla to bring their PE back down to 30, they would either need to drastically increase their revenue or what was the other one?
Or the price has to go down.
Or the price has to go down. There's
Right.
no two ways about it, right?
Right.
And when I was looking at it, Tesla was worth the combined value of like the next 10 car manufacturers. And I was just like, that's just
That's
not
right.
you can't argue with the math there. Unless for some reason the world only goes into Tesla, it's not happening. So based on my
Maybe
math,
not.
Tesla only has down to go if the like maybe not in the short run, but in the long run, like either Tesla takes over the world or Tesla drops. Like those are the two outcomes in the next 10 years. That was basically how I looked at it. This is again not financial advice. This is just how I think about the using
No.
PE
Well,
for
no, that's how everybody, Colin's thinking about it the way every person in finance will think about it. Now, the question is it justified or not? And that's the case. So I also manage our student run portfolio. We got about $5.5 million of money the students run, and they got to make this pitch to actual CFAs and other folks, and they have to make Colin's case. So if you want us to put money in a high PE stock, you have to justify that the earnings are going to come up drastically in the long run, and they might in the long run.
They might.
And
You never know.
And they might, or they won't, or maybe we're still early in the Musk administration, though, Colin. Do you think that Tesla can make it through as
I
a
mean,
dominant global player?
we've definitely seen a few line items
Yeah.
being awarded to Tesla on the government budget, which is interesting. I don't know how far that can go and whether Tesla has any future growth as a potential, governmental contractor-ish sort of thing. But even at Tesla's current evaluation, if you look at other um, major government contractors like Northrop Grumman and Boeing, like they're nowhere near Tesla's evaluation. Tesla's evaluation is quite literally assuming Tesla wins like a good large chunk of the global market or close to like 80 to 90% of the US market. And that would be quite an interesting thing to see if it does happen, which would justify its current evaluation. It's just unlikely. I never say never, it's just extremely unlikely. That's all.
You're absolutely right. So,
Yeah.
Colin, I love your perspective on this too. And this is absolutely, you're not wrong. The question is exactly, and this is the hardest part about Tesla. And this was something because I always get students every year. They're like, we need to buy Tesla. And then I'm like, oh, what are you saying? Well, justify it from a PE perspective. And they've gone up and they've been grilled to death, just as you just said, Colin, in the same exact, you could be a CFA or a hedge fund manager, just the way you speak of it. And of course the stock price has done, sometimes it's gone up and sometimes it's gone down, but in the last few years in general, it has gone up a bit. And this is the really hard part to justify because fundamentally a stock price is nothing more than the present value of all the future profits, the earnings that the company are going to bring you. And when you own a share of stock, that entitles you to a share of its future earnings. It's ownership. Ownership implies control. You elect the directors, directors hire the CEO, boom goes the dynamite, sunshine, rainbows, unicorns. That's how the economy works. But the United States is interestingly a very dominant equity market. About 50% almost of the entire value of global equities that are floating around in the world, which is really amazing, considering that we're a much smaller percentage of the overall economic size of the world. And so our equity market is the oldest, biggest, deepest of the big markets that are out there right now. But what does this mean in general? And I know people are like, well, Amsterdam had a stock exchange in 1602, and of course they did, but among the big markets. So the US price to earnings, the market right now, to Colin's point, for everything is pretty expensive. The average PE ratio is almost 38 if we look at the US market. If we compare that to Europe, Australasia, and the Far East, EFA, which is that blue line, they're much cheaper. And then emerging markets right now are just freaking cheap. They have a 15 PE ratio. And so the question is, will investment shift overseas to what appears to be a better value for risk in these countries? And that's the debate. And so this is a really interesting question to ask. And as Sakura points out, a lot of those economical e-cars from East Asia, Japan is holding on to some incredible vehicles as well. Absolutely true. Very interesting. DoorDash has a PE of 708. So to Albert's point, if you happen to just make no money last year or very tiny, like a fraction of a penny, you'll have an outrageous PE. You can have PEs in the thousands, but then you could actually lose money and have a negative PE, which is objectively worse. We need to have a 24-hour small business plan across the United States. See, that's the best part about Aaron. Aaron's just going to drop like facts in there about that's what no, don't look at the market. Small business plan across the United States. Yeah, don't be distracted by this. Go full Aaron. So this is another concern. Inflation indices, even before none of this data, by the way, incorporates tariffs or incorporates other things, but we're seeing regional inflation. This is from the Philly Fed. As well as the New York Fed, coastal Feds, we're seeing regional inflation in the country start rising. And this is concerning to us. We're seeing CPI reaching 4 potentially. Bringing that down, and my final and last slide. Thank you for your patience. Looking at San Francisco and San Jose, looking at the actual December jobs report numbers in both areas, saw some encouragement. Unemployment dropped 6,000 in San Francisco, dropped 2,000 in San Jose. Unemployment rate went down to 4 and 3.9. But why? And what was the reasoning for this? And so far, although this is a nice little little e's to show that the economy as a whole, people are having jobs and they can get jobs. It's cycle to cycle and it's sector to sector. And so we didn't see huge growth in any individual sector that would give me hope. We saw a loss of 3,000 government jobs. We saw an accommodation of non-farm employment went down a bit, which was really interesting. And I suspect much of this is actually pretty steady state for the Bay Area rather than being indicative of something. But information added about 1,000 in December in San Francisco and about 300 jobs in San Jose. And some very, very interesting stuff coming down the station. So let me adjust this back. And I know I've taken all your time. Thank you for those of you who hung around so far. And thank you for all of those who attended. But yeah, questions and comments that we didn't cover. Thank you for letting me go through all of those things. Sorry for the hurry up offense at the end. To Colin and Albert, what do you guys got? Oh, thank you, Sakura. That was really nice of you. Let me adjust my.
What should we expect with the next month?
Oh, yes.
Is it time to start the betting pool for our first negative jobs report given government layoffs?
Yes. When we should start a betting pool for the negative jobs report. If government layoffs take effect, now this is the hard part, right? Because they're going to get 8 month severance package. So depending on when this happens, when we have initiate, when this is reported or not, next few months it's a risk for sure. And uncertainty is still a risk. What do you guys think? Do you think it'll happen in the next 6 months?
Things are just really hard to predict with the current administration.
So
There's so much uncertainty. What's going to
There's
happen?
so much
What's
going
new?
on. I mean, for example, Trump just announced a gold card. You can pay $5 million for a US citizenship. And I guess the stated idea is to attract wealth into our country. Um,
With
this,
investment. Yeah.
regardless of how you feel about who he is, attracting wealthy people to our country is nominally a good concept. I just don't know what that means in the long run because I don't think we've ever had a historical
Mm.
example of mass immigration of the wealthy into a country and what that means for the economy as a whole. I think this is uncharted territory.
Oh man, I think you're right. So this is interesting, right? So a lot of countries do different things to incentivize these visas, right? I mean, we saw Portugal do it. We've seen other countries globally do it. We've seen a lot of developing countries go. We have Nauru doing it. We have all these other countries that look at questions about encouraging investment in this way. And does it really do that? Does providing residency in this capacity increase citizenship or investment at a localized level? Sure. But more compelling is that we already have a large diversified equity economy, and it's not like we're at a lack of investment and investment people. It's likely not going to have a huge impact on the U.S. economy, in my opinion. And this is interesting. And now this is cool too. Oh, good questions too. Let me get to some of these here too. Vanita says, when will new job creation happen? So this is really interesting. One of the unknowns here that I didn't touch upon is looking at the relationship between the Federal Reserve and the government in other respects. So the Federal Reserve is an independent body. Obviously, the president appoints the chair of the Fed. And Jerome Powell has been very adamant at controlling inflation. Now, if inflation starts ticking upwards, those cuts that we expect with the Fed aren't going to happen, or they'll happen at a much slower rate. If inflation is concerning for tariffs, for trade reasons, for other things, those cuts might actually reverse. And so one big source of uncertainty regarding business is if rates came down, that decreases, and what that does, by the way, the Fed decides one rate, overnight lending to big banks. That's called the discount rate. It has a ripple effect on all the other rates in the system. So what it's a nice way to look at is when those rates come down, we see the cost of capital start dropping. And the cost of capital drops, and that means businesses look, it's cheaper for them to take out money and build things and hire people. And so that's why when the economy is struggling in a recession, we lower the interest rate, and that incentivizes job growth. And if we can continue lowering the rates, to Vanita's point, then we will reach a position where we'll incentivize job creation, we'll incentivize the building of new firms, and we should see a potential recovery period. If it goes the other way, if inflation increases, and that's the real risk, is that a combination of trade policy and other government issues and other things forces the Fed to kind of slow down this decrease we've seen in rates, that will have adverse effects on that growth. And job creation will happen if rates decrease? And that's a really good question. Tammy asked, do you anticipate that higher education bubble will finally burst? This is a really interesting question, and it's something I think of a lot, Tammy, being that my job is within higher education. So at this very, very interesting time, it is 100% a bubble. We have, of course, I'm an administrator as well as a tenured faculty member. So I will say that there's been reasons that administration costs have increased, but there's a lot of administration costs. And of course, we've seen I can give you 100 charts that show why higher education is inefficient in the way that we do things. There's a lot of unknowns about higher education right now, right? And so the bubble might burst. I think we're facing demographic headwinds. We're facing fewer college students around and more people with college degrees, and also looking at the value of those college degrees. I think colleges are not built in general to react well to economic changes in a reasonable amount of time. And I think that the colleges that will do well are ones that will adapt to this market. And so it's not that it's a bubble bursting, it's an expectation. If colleges are aware of what people want, they will adjust those expectations accordingly and do everything they can to ascertain that whatever they're charging you increases value. So I just ran some calculations here. Our programs are relatively cheap. They're about $30,000, $24,000 to $35,000 for graduate degrees, right? And so we have a bunch of data, and so we still generate a 4 or 5 times, even discounted with time value of money, return on income over your career pathway because of our degrees. So we consider them quote unquote worth it. But a lot of degrees are not. And so it's of essence that we update this in a way that's meaningful. I think AI is going to have an effect on everything in the way that we do business. And I think this will really we'll be in some very interesting waters in the next 2 decades or so. Scott says, does a lower PE ratio in an EASC comparison to the rest of the US spur overseas investment in areas that compete with China? Hypothetically, yes. And this is really interesting, Scott. Hypothetically, that is the case. But you're also competing with areas with questionable rule of law and other government issues. And so the hesitation in investing internationally in any case is whether or not that shareholders will get the same returns. Ross says, if AI tech has a say, new job creation will stall real hard. Maybe so, but remember, it takes decades for new technology to go through a system. It will make the top 5% be over 50% of all the spending. True. Marcia says, I think we've had an investment path to residency, so the 5 million just sets a new limit. Agreed. Yeah, that's true too. It is a new limit. I don't see a huge thing. Oh man, I have to ask your college roommate and economic professor. Articles, Sakura. That's great. And Scott says, thanks. All right, Colin, I'm sorry. Let's stop talking. Thank you so much, guys. That was great. I had to get through those. Those were awesome.
This is good.
So, are we expecting lower interest rates? Are we expecting, I mean, I don't even know how to explain this economy anymore. Um, will the information sector come back? What will be the I'm running out of hope. Well, not hope, but I'm running out of analysis.
I'm running out of the analysis.
Oh,
So I know we ask this question often, and we say, what is going to happen? And that's the real
yeah.
thing. That's the real thing. So uncertainty is the name of the game, and the Fed is the name of the game, and we can't take our eyes off the ball, right? And so, in the spirit of Roy Cohn back in the 1960s through 80s, 1950s through 80s, when he was all about attacking. We've got a lot of things thrown at us, and a lot of these will have economic effects, and a lot of will be noise. And so, determining what's meaningful is going to be the name of the game. Now, it won't change most people in the private sector's day-to-day management anytime soon, but there are going to be concerns. So, if the Fed's got to lower rates, they're going to be looking for inflation questions. And if tariffs remain low or specialized or in certain sectors, we won't see prices come up a lot, but it may cause the Fed to pause. But we're also going to see, we're looking at a lot of money sloshing around in different areas in private equity and other returns. And we have to watch these markets because all of this affects the bottom lines of institutional pensions. Right now, and looking at some historical data, I'm concerned more about, my biggest concern in the next year and a half or so is market corrections based off of irrational exuberance. And something that was overcorrected, leading to a situation where people go from where the reality on the ground of people saying, promise, deregulation and money, and let's ride this train forever, suddenly pushes back. We've had 2 incredible years in equity markets. I think those, and if we see a bad year coming forward or a bad year in 2 years from now, that will send a lot of people questioning and saying, seeing that 401k effect, seeing a decline in wealth effect, that will affect their spending habits meaningfully and could be a catalyst for a change in the economic situation. But I think, and thank you again for dropping this, there are so many unknowns. We're going to talk about it. So send Albert your questions, and I'll be happy to try to connect with as many as I can.
Yeah.
I tried to hit a
I
bunch
look
of
forward to
things at
this
least.
webinar every month because I see the news and I'm like, what is Dr. White going to say about that? So,
Oh man,
yeah.
there's disconnects. We talked about disconnect. Thank you, Albert. I was thinking about what Albert and Colin are going to say about the market next. So that's what I
Well,
say.
like one of the
So
things I feel like I've noticed since the new presidency began was
yeah,
start out the year with a lot of, I think, job activity, and it
yes,
seems to have slowed down over the last couple of weeks because we're not quite sure where policy is headed, even though it's very much defaulted to AI and so forth. I just noticed,
yes.
what comes through my inbox and the volume of it, and that's not really a leading or lagging or really any kind of indicator. It's just a sentiment. So, you know, yeah. So. All right. Well, doesn't look like there are any other questions. Please connect with Dr. White. Please connect with each other. I encourage you all to continue this conversation over the next month. Our next conversation around this is March 27th, same time, same place. Please come back. We will see how the world, the economy has advanced in the past month. And you're always welcome to ask your questions. I take most questions that are asked through our Eventbrite form, and I pass them on to Dr. White about a week before. So if you wait until like 3 hours before the webinar happens, it's not likely your question will get to Dr. White. We also have a lot of other events coming up, so check them out on our Eventbrite page. We look forward to seeing you soon. The recording of this will be on our YouTube page as well. And we wish you all the best in your next month and look forward to welcoming you back for this conversation soon. Have a good night, everybody, and goodbye.
Great questions, everyone. Thank you so much for coming.
Cheers.
Yeah, thanks, Melody. You rock. All right.